My name is Jake, welcome to the channel. In today's video, we're gonna do a review my pie video where I review subscriber portfolios. I really enjoy this series because I see it very different than the other videos here on my channel. I see it as a casual conversation. I love seeing how different people all across the globe are looking at dividend investing. I love reading your emails and hearing different people's experiences and opinions on how they're trying to live off of their dividend portfolio. And because that's what it really started with why I created this YouTube channel, was to really document and share my thoughts and opinions. And, some things have evolved over the years, right? But from the very beginning, when I started the YouTube channel here, about 6 or so years ago, it was all about helping other people learn how they can retire or live off of their dividend portfolio. When I first created the channel, that was my goal, or I guess you could say my dream at the time, was to one day live off my dividend portfolio. And things have changed quite a bit since I first started my YouTube channel. I'm now living off my dividend portfolio for the last 2 years. I'm living what's called barista fire, where I'm still working part-time, but also living off of the income from my portfolio. So in today's Review My Pie, we're going to take a look at one question, and then we're going to look at 3 portfolios. The question is from, I don't know where they're from. I'm assuming here in the US because they're talking about, US ETFs. But the question here, I don't know how old the person is. The first portfolio is going to be from a 30-year-old here in the US. The second, a 19-year-old from the US. And then the third, a 45-year-old from Italy. And as always, everybody, the timestamps will be in the description below, as well as the portfolio links. And as always, everybody, please don't take what I'm saying as financial advice. This is just merely for your entertainment. And I don't review the portfolios in advance. I'm reviewing them as I record the video. I try to make it as casual of a conversation as it can be. So none of the things that I'm saying in this video are scripted. And that's just something that I've kept that format for many years. And I really prefer it that way. This question I got from one of the Review My Pies, I think last one or the one before, but I noted it down because this is a comment that I see pretty often. And so I wanted to talk about it here in this video. So the question is, I'm looking to add a tech or technology ETF as a satellite position. He's currently in 50% SHD and 50% DGRO. Any recommendations? So first off, I think this is great because this person is taking inspiration from my channel and following what I call the simple path to wealth with dividend investing, which was inspired by J.L. Collins, where you have a core portfolio of SHD and DGRO, and depending on your time horizon, your satellite positions, this is part of the core and satellite portfolio, right? Your satellite positions help you to reach your goals because everyone is in a different situation. This person here is probably a little bit younger or has a longer runway, longer time horizon, so they're looking for a little bit more growth. Now, if somebody was in their 60s or late, 70s or whatever, right, they're not going to want to go and throw everything, on growth and bet the farm on it because they have a different time horizon. So I love that this person is following what I'm saying. And a lot of people ask me, well, can I do this? Am I allowed to do this? Can I do this? Is that okay? Everything that I talk about on my channel as it pertains to the simple path to wealth with dividend investing, see it as a guideline, not as a rule. Okay? Because a lot of people, especially here on YouTube, they want to be told what to do and what to think. I try to help you understand how to think and how to look at this. And it's very, very different than telling you what to think. Now to answer this, I'm going to head over to Seeking Alpha and I'm going to give you a few examples. So whenever someone asks me, hey, what is your favorite growth ETF or technology ETF? I generally will say the same ETFs, and I base this off of a few things, a low expense ratio, a generic index that's not actively managed, it's a passive index, but there's a few things that come to mind. Now, if you're wanting pure technology, right? You want heavy exposure into Microsoft, Apple, Nvidia. And I mean heavy, right? 13% Microsoft, 16% Apple. This is an ETF that you may want to consider. This is the Vanguard Information Technology ETF that's just focused on technology. Okay, so you're only going to have technology stocks in this ETF. You're not going to have companies like Meta or Amazon, right? Because those are classified as communication stocks, and in some cases, I can't remember what Meta is classified, but Amazon. Meta is communications, and Amazon, is it discretionary? I think it's discretionary if I'm not mistaken. But some of the things that you absolutely have to understand, in ETF like this, it's going to be very top heavy. You're going to have a lot of exposure into Apple, Nvidia, and Microsoft. Now, there might be some smarty pants in the comments, or you might be thinking to yourself, well, Jake, you always say don't invest more than 5% into an individual stock. And if you were to think that, you would be absolutely correct. I do think that. But you also would probably know, if you're a long-term subscriber of my channel, that VGT is one of my largest holdings in my Roth IRA. And it's because it's an index fund that is market cap weighted. I want to explicitly have more exposure. I explicitly want more exposure to technology, and I choose to invest into VGT in my Roth IRA. And sure, yeah, Apple is at 16%, but I don't care if I don't care as much, right? I don't care if Apple's at 16 or 5%. This index represents the technology market in America. So if Apple is doing well, it's going to represent more in this index. If Apple starts to lose its moat and they start to go down in market share, well, quarter over quarter, year over year, it's going to be represented less and less in this index, in this ETF. But I don't have to actively manage that. So that's how I view this. I let the market do what it's going to do, but it is very, very important to understand that it is very top heavy. You're going to, like, for example, I wouldn't have this as a satellite position and then 5% more in Microsoft or in Apple, right? That's something that I wouldn't do. But if you wanted 5 or 10 or so % as a satellite position in VGT, absolutely fine in my opinion. Now, to answer this person's question in terms of technology ETFs, ones that I do recommend. So if you want pure technology, go with Vanguard, in my opinion. But if you want to have a little bit of tech, but also you want more growth in other sectors, maybe not necessarily, just tech, you can look at an ETF like SCHG. This is the Schwab US Large Cap Growth ETF. This is a very high quality growth ETF that's focused on, on larger organizations like Apple, Microsoft, Nvidia. So you have to understand, if you were to buy both of these, you're going to get a lot of overlap. Right? So that's just something to be mindful of. I wouldn't go out and buy every single one of these. You could combine VGT with some of these, but I wouldn't go out and buy all of them, right? Because you are going to have a lot of overlap. But what you'll notice with other ETFs that are not just specific to technology, the majority of them that are growth centric are going to have about 50% into technology. Another growth ETF that I like is VUG. All of these so far have had very low expense ratios. They're very, very similar, right? But in this case, you are also getting Meta and Tesla, right? Whereas with VGT, you weren't getting Meta and you weren't getting Tesla, if I'm not mistaken. No Tesla, that's right. So you're getting a little bit more of a wider reach into different sectors than just technology. Another one that I give my stamp of approval on is SPYG. I own this in my son's account that we have for him, our son Lucas, who's 3.5 right now. So we own this in his portfolio. But once again, the same thing, basically Apple, Microsoft. Like I said, I don't think you need to have all of these. I would just pick one or two and call it a day. And then lastly, if you wanted a vanilla one, you could go with the NASDAQ 100, the QQQM version of the NASDAQ 100. I do like this ETF. You're getting 50% into technology. The cool thing about this ETF is you are getting other sectors in here. If I'm not mistaken, like PepsiCo is in the NASDAQ 100. So you're not going to get just, software companies. You're going to get a lot more in the NASDAQ 100. So I hope that this answers your question. These are my favorite growth ETFs. All of these have, an overweight into technology. As I mentioned, the first one, VGT, is 100% technology, but I will throw in there, as I already mentioned, I wouldn't go and just invest into all of these because there is quite a bit of overlap. I would just pick one or two and probably call it a day. But that's just my opinion. But thank you so much for the question. I hope that answers your question. I made videos on the best growth ETFs on the channel. You can go check those out if you want to see these ETFs, like for example, the SPYG, VUG. I've analyzed these in depth in other videos on the channel. But thanks for the question. All right, let's take a look at the first portfolio from Steven. He writes, "Hi, my M1 pie for consideration. I'm 30 years old, started investing in 2021, made some mistakes chasing returns, but now focusing on long-term growth with low to medium risk. I'm maxing my Roth IRA every year and splitting the remainder between savings and my individual account. I'm dollar cost averaging into both the individual and Roth every 2 weeks. What are some adjustments I should make now or as I age?" The very first thing that I would encourage you to ask is, don't ask the question, is this a good stock? The first thing that you want to ask yourself is, why am I investing? What am I investing for? Because the reason why people make mistakes is they don't really know what their goal is, what they're doing. And there's nothing necessarily wrong with that. How many people do you know went to college with the idea of going into one major and then they changed their major? Because life happens. And so the very first thing that I would recommend to you or anyone who's fairly new to investing, before you really, start getting down on yourself for making mistakes, is to first understand and try to figure out, why are you investing? Because it makes life, the world of investing, a heck of a lot easier if you know why you're investing and what you're working towards. And it helps you to change your mind a heck of a lot less, especially when the market's volatile. And that's just some words of advice from somebody who's been in your shoes, made many mistakes. And if I could go back in time, that's what I would tell myself. And things would have been a lot easier, but that's the very first thing that I would tell you. All right, let's take a look at your portfolio. You got 13 slices in this portfolio, and I'm looking at this. Now, I promise you, I did not look at these portfolios in advance, but the irony of this, that the largest holdings are SPYG and VGT. I have nothing to gain or benefit by anyone going and buying these ETFs. I just genuinely like them, and this guy's doing really good for, just starting out. These are great ETFs. Okay, so you got 50% into growth, and then you got DGRO, you got Google, you got Apple. So we know he's got a lot of overlap with Apple and Google by holding these ETFs. Remember that? And Microsoft. All right, so what else has he got in here? He got the Trade Desk, so a lot of growth. He's got his Palantir in here, his waste management, and he's got his SEHD. SEHD is 15%. Okay, so it sounds like 50% of your portfolio is tailored toward growth and 50% is tailored towards dividend growth. At face value, I really like this strategy. You have a very low dividend yield. You have a very low expense ratio for this portfolio. You're investing into some individual stocks that you probably believe in or you are a big fan of. What makes me think, it makes me think that you probably work in tech or in technology, because you have some pretty, a cybersecurity company in here, AI company, fintech in here. So there's a interesting makeup here. So what I like about this portfolio is, the main thing that I like is it gives you flexibility, right? 50% into growth, 50% into dividend growth. And the idea here is that your dividend growth, you're never going to sell, and you're going to hold it and just let it grow and grow and grow over the next 10, 20, 30 years, however long you have. So that's with the dividend growth. With the growth here, it gives you a lot of options, because in 5 years, maybe you get married, you move out to the suburbs and you want to buy a house, right? Okay, maybe you could liquidate some of your portfolio and you could buy a house. Maybe you want to buy a rental property. That's what I did. When I was in my mid-30s, I liquidated my portfolio and I bought real estate. And the reason why I'm saying that is coming back to your options and flexibility. So I really like that you're taking this approach, and I think it works very well in an individual taxable account as well as in a Roth IRA. So I'm hoping that you're doing something similar in your Roth IRA. All right, let's take a look at your Roth IRA. I promise I'm not looking at these. I said I hope he was doing something similar. In fact, he's doing something very similar. He's got SPYG, he's got VGT, and he's got a few individual stocks in here. And he's got some real estate as well. Okay. Oh, wow. This is way too much in stack. So, all right. So let's back up here. So I like the strategy here, right? You're basically half in growth, half in dividend growth. So everything that I just mentioned for your taxable account, it applies for your Roth IRA as well. But the benefit with your Roth IRA is you're not going to pay any taxes, right? You invest into VGT, SPYG as an example for the next 20 or next 30 years, right? I think you said you were 30. So when you reach the age of 59 and a half, you can sell all of this and pay zero capital gains. And then what you could do is then you could buy more SCHD, maybe a covered call ETF, right? A high dividend ETF, high dividend stock. It gives you a lot of options. You could go and take a cruise to the Bahamas, right? Like it gives you options. And the ETF allocation in here, you got 40% into SCHD and DGRO. I like that. This is a little bit nitpicky. This is just my opinion. I don't think you really need the exposure to Microsoft, Google, and Apple. This is just merely my opinion. I don't think you need it, especially because you have so much exposure in your ETFs. But I can understand why, and I don't fault you for it. When it comes to real estate, you have 5% in real estate, and you got Stag in here. Me personally, this is a little bit nitpicky, but I would remove Stag in this situation, and I would just throw it all into VNQ. And then in 30 years, you could sell a percentage of VGT and then buy Stag. Because it's a matter of understanding total returns. You're going to have a higher total return in a growth ETF, one would assume, right? I don't have a crystal ball. Past performance is never a guarantee of future performance. But if we look into the future and we assume things stay constant, who knows? The math says that you're going to have a higher return by doing something like that versus, having a lower return, even though it has a high dividend. Stag has a high dividend. And mathematically, you would be likely better off with focusing on growth and then adding Stag later. And so you kind of think about this kind of like a target date fund. You have 30 years for your Roth IRA. Okay. You don't want to start adding stocks that you would add in 30 years today. Okay, that doesn't make sense. That's not how you would want to look at this. And it's a very easy mistake to make. A lot of people make that mistake. Don't build your portfolio today as if you're retiring tomorrow if you have 30 years. And this all ties in to that magical, beautiful topic that I always talk about is understanding how to invest based off of your investment time horizon and understanding the rule of 72, growth rates, all that good stuff. So all in all, I like this. I like the mix of growth and dividend growth. I love that you have an emphasis on ETFs. This will make your life so much easier. Thank you so much for sending over your portfolio. I hope that helps. All right, the next portfolio is from Casey, who writes, "Hey Jake, I'm 19 years old and able to contribute a little to my Roth last year and determined to max it out this year and in the future. I wanted to go with strong return approach while also making sure that these companies will continue to keep their products going and adapting to our current competitive market, therefore having a lower risk. Just wanted your thoughts and how you think I have set this up for a long-term portfolio." Okay, so you're 19 years old, you're setting up your portfolio, you're investing into a Roth IRA. I think this is all great. When we think about investing, a lot of people on YouTube just talk about what to invest in. I always emphasize this, that it's equally as important to understand where you invest, meaning in which account, as it is to, what you invest in. Okay. So I think, you're 19 years old. Let's take a look at it. So this is your Roth IRA. It looks like some of the holdings that you had in here are no longer available in M1. Okay, whatever that is. All right, so let's take a look at it. So you got 7 slices in here. You got industrials, you got technology, consumer tech, finance, energy, and healthcare. Let's take a look at your industrials. You got Caterpillar, Honeywell, UPS, and 3M. Okay, I'm not going to get too nitpicky on the percentage allocation. Me personally, I would probably keep it simple and just equally weight them. But, the reason why I say equally weight them, because I've been through this circus many times where, I always would second guess myself. I'd be like, should I do 35? Should I do 30? Should I do 15? And just like focusing on the little stuff that's not really going to move the needle. And so for me, through my experience, when building out my portfolio, I was like, you know what? I don't really care. I'm just going to equally weight them, whatever. It's not going to change. It's not going to move the needle much. Okay. But that was just my personal opinion. You know, so there's a lot of people out there with bigger, that are more OCD than I am. So now let's take a look at your technology slice here. You got Apple, Microsoft, Texas Instruments, and NVIDIA. Let's pull up the calculator here and take a look at that. So you got 33 in Apple. The slice is 33. So you almost got 11% in Apple. I'm not the biggest fan of that, even though Apple and Microsoft have done very well. I think, you know, especially for a Roth IRA where you have a long-term time horizon, and you said you're not really risk averse, like you're less risk averse in your email. You didn't elaborate too much on it, or develop guidelines that you can follow that will keep your emotions out of it, because you're going to be investing for the next 40 years in this account, in this Roth IRA. And Microsoft could do very well. Microsoft could not do very well. And it's all about risk management. And in my opinion, I prefer to just, you know, throw an ETF in there, and it makes your life a lot easier. But that's my opinion. And if you did want to hold Microsoft, I probably would reduce it to more, you know, 3, 4, 5%. I wouldn't keep it at 11%. Okay, so what do you got in here? You got, this is the consumer slice at 20. You got Costco, Walmart, Home Depot, Kroger, Nike, Starbucks, and Waste Management. All really, really great companies. They're more skewed towards growth. And for your time horizon of 40 years, I think is fine. What do you got here in consumer? You got Disney, Google, and Amazon. Okay. What do you got here in consumer? Oh, those are consumer tech. What do you got here in finance? You got Bank of America, Visa, MasterCard, JP Morgan, and American Express. So quite a few holdings for only 5%. Now, when it comes to energy, I do like that you only have 5% in here, but you know, you're 19 years old. I don't think you should really be looking at EPD. EPD is great for your dad and your mom to invest in with their time horizon, but not with your time horizon. In my opinion, this is a little bit nitpicky because it's only 5% of the portfolio. I don't like the energy slice. I think you would be better served focusing on more of a growth area of the market. Now, I don't know what the market's going to do, but I personally would much prefer like a growth ETF, like a DGRO or an SCHD or something like that. Or if you wanted more of a value ETF, you could go with VYM or VTV, which hold energy stocks in them, utilities in them. So I personally am not the biggest fan of this slice. I probably would reevaluate that. In terms of this slice, you got Stryker, AbbVie, and Oracle, all really, really, really great companies. And okay. So you don't have any ETFs in here. This is what I would say to you or anyone watching. I personally, I've evolved in terms of, how I view dividend investing. I used to only invest in the individual stocks. I would only invest in the ETFs in my 401k while I was working. And I've dramatically changed how I've been investing. And sure, I would get a lot more clicks and views on YouTube if I talked about individual stocks. It's just the reality of things. People want to hear people talk about, the risk, risk on, right? That generates a lot more eyeballs than somebody saying, hey, you should probably de-risk this and make it a little bit more conservative. People don't want to hear that, especially when in a bull market. So I'm going to tell you maybe not what you want to hear, but some sound advice, at least from my perspective, having experienced, a couple of things in my life. Right. So I've made a lot of mistakes over investing into individual stocks. You, however, you don't have a lot of risk, right? You're investing in a Microsoft, at least as we perceive it today. That's the funny thing about risk. You can't know forever what's risky until it happens, right? So hindsight 2020 with risk is always fun. But the way that I would recommend looking at this is research on the investing approach, core and satellite. Research understand and learn about the core and satellite approach to investing, because I think most people would be better off if they had a core portfolio of ETFs. My personal favorites, if you want to never sell your shares and live off your portfolio, I personally prefer SHD and DGRO. And then that's your core portfolio. That's your fortress. That's what's going to get you through the good and bad times. Then if you want to build out your portfolio, you have a longer term time horizon, and you want a little bit more growth, you can be disciplined about it, and you can have satellite positions that meet your goal, right? And so what I would recommend, a portfolio like this, you add ETFs. You change the target allocation. I would have between 60 and 80% into ETFs, and I would have the remaining spread out across your favorite satellite positions. And that's how I would recommend doing it. Now, you are young and you probably don't want to hear that. You probably want to hear, what are the best 10 stocks to buy? And, that's probably what you want to hear, but I'm not going to tell you that. I'm going to tell you what I wish somebody would have told me when I was 19 and when I was first learning to invest. I wish somebody would have told me this, because I would have made a lot fewer mistakes. And that's why I'm telling you. But yeah, take it for what it's worth, I guess. I'm just trying to share with you what would have helped me and things that I've learned. But yeah, thank you so much for sending over your portfolio, and I hope that helps. All right, the last portfolio is from Julio. He writes, "Hi, Jake. I was looking at your YouTube channel and it's very nice. Thank you so much." Oh, thank you for saying that, man. I have been investing for about 4 months only. I'm 45 years old, investing $4,000 a month, and I need to pay 30% taxes on the dividends. I'm not a US resident, planning to retire at about 60 years old. And you have DGRO is with 0% invested, planning 10%, because I just added it into the portfolio and split with SHD 22%. Could you please have a look at my portfolio and give your experience and thought? I really appreciate your attention. So yeah, so Julio, you sent me another email. You're from Italy and you have about 50 or so US dollars invested. You're investing a very, very good amount monthly. So you're either working a really good job and or you have very low expenses. So kudos to you for putting away so much money or investing so much money on a monthly basis. So you're 45 years old, you're investing a very good amount every month, and you have a 15-year time horizon. So you have 15 years, and within a 15-year time period, that's an entire economic cycle. Economic cycles generally last around 10 years, and in an economic cycle, you should expect 1 or 2 crashes or recessions during that time period. So over the next 15 years, you're going to have years when the market is up, you're going to have years when the markets are down, and it's important that you are always investing no matter what the market is doing. You have a flat rate of a 30% tax on your income, and so if that's the case, you may want to consider focusing on growth for now. Something that comes to mind is you may want to take a hybrid approach, right? Where kind of like what the other portfolios were doing, where you're doing half in growth and half in dividend growth, so that it gives you more options. You're not paying as much in taxes now while you're still working. And in 15 years, you could rebalance your growth into higher yielding dividend stocks and ETFs. So that's what I would recommend before even looking at your portfolio. I would put together a strategy, a methodology that you can follow and that you can, something that you can work towards, because I think that will help you to guide you with what you're trying to do here. And that's just my 2 cents. But I think, based off of what you're saying here, 15 years is a good amount of time, but I would not go one or the other. I would do a balance of both. Meaning not just only focused on growth and also not just focused on dividend growth. I really like the idea of a balanced approach, and I think that would serve most people very well. All right, let's take a look at your portfolio. So your top holdings are by percentage or by allocation. You got SHD and DGRO. You're following the simple path to wealth with dividend investing. Beautiful. I love it. Okay, that's great. So you got Realty Income. It's a real estate investment trust. It's a REIT. It's got a good, healthy dividend. Very good. You got Bank of America, Johnson & Johnson, Main Street Capital. You got the Chevron, UPS, Verizon. So very, very income heavy for the most part, though you do got some Starbucks in here, with a lower yield. You got Vici, another REIT in here. And it sounds like, I don't know the tax laws in Italy, but it sounds like you have a flat rate regardless if qualified or non-qualified. So it doesn't really matter as much if it's a REIT or not, is my understanding or my assumption, right? And you got PepsiCo, you got Procter & Gamble, you got Lowe's, you got Canadian Bank, Royal Bank, you got AbbVie, you got JEPI, okay. You got Coca-Cola and you got the Toronto TD Bank. Okay, so this is a really good looking portfolio. At face value, I really like what you're doing here. You have no one holding allocated more than 4%. So that's your target is 4%. So you absolutely are following the channel. I love this. I think, at face value, I think this is a really, really great approach. Now, it's very possible over the next 15 years that you may change your mind on a few things. You might consider, increasing your allocation or decreasing it to one of these, high yielders, right? I'm not going to speak necessarily to any individual stock, though I will say these companies are really good, right? These are more of your sleep well at night. These are not growth, startups, right? These are companies that are well established, have cash flow, and that's all a good thing if you're focused on the income. So I guess the main thing that I would share with you and anyone in a similar situation is the way that you look at this. The important thing that you want to look at here is what is the portfolio average dividend yield and the portfolio average dividend growth rate. That is the number one thing that you are trying to solve for. If you are not thinking about your dividend portfolio from a weighted average perspective, you're doing it wrong. Okay. And I wish somebody would have told me this many years ago when I was building my portfolio. You don't look at a portfolio like this as, the individual positions. Every single piece is like a piece of a puzzle. And if there's one piece missing, the puzzle is not complete. So you want to look at your portfolio as a complete, holistically all around. What is your overall portfolio yield, average, weighted average, and what is the weighted average dividend growth rate? And if you haven't already done that, or anyone watching, I highly encourage you to do it. It's a little bit more time consuming if you have 20 or 30 stocks. It's very easy if you just have a handful of stocks or ETFs. But by looking at your portfolio that way, it helps you to solve your question. The question is, well, how much money do I need to pay for my expenses? Well, that's where you have to start. Well, what are your anticipated expenses? And a lot of people, and myself included, when they first start out, they don't look at it that way. So the way that you want to look at this is you want to first start with this. What is my time horizon? In 15 years, I want to quit my job and I want to live off my portfolio. Okay, that's great. In 15 years, what do you expect your expenses to be? Now, the short answer here to help you with this is you're not going to know for sure. Okay, if you own your house, if you rent, if you like to travel, all of those variables, all you can do is use your best guess. So that's where you start. You start with, well, in 15 years, I need, because I'm going to have a pension, I'm going to have Social Security, I have a rental property, I got this, I got that, et cetera, et cetera. I need my dividend portfolio to pay me at least $10,000 a year. And so if we pull out our calculator here and we take a look at this, so you need $10,000. Okay, now let's assume that your portfolio weighted average yield is 4%. I don't know it. This is why you have to calculate this. Let's say your portfolio average yield is 4%. That means in the next 15 years, you need to build a portfolio that yields 4%, but that portfolio has to grow through the contributions and the reinvested dividends up to $250,000. Now you might be thinking to yourself, well, Jake, that's too much money. I can't save that much money in the next 15 years. Okay, well, then you need to change your portfolio. You need to change your portfolio to a different mix. That is assuming that your expenses are not going to change. So you have a few different levers. You can either change your expenses or your portfolio. Okay, well, you're saying, well, Jake, I gotta drink a lot of coffee and tea and, a lot of, bruschetta in Italy. It's getting expensive. Inflation's a thing. It's got to be $10,000. I love bruschetta, by the way. So, and pizza, olive oil on my pizza. It's the best thing ever. I had olive oil, pizza and olive oil. I had pizza in Rome many years ago. Tourist trap, really expensive, but they drenched it in olive oil. Mwah, amazing. Anyways, so let's say, for example, that Julio's like, you know what, Jake, I can't do 250,000. Well, okay, we got to change the portfolio. And so then what we got to do is we're going to say, okay, well, we got to build a portfolio that has a weighted average, dividend yield of 5.5%. Well, that changes things. Instead of $250, Julio needs $182,000, significantly less than the $250. Now you might be thinking to yourself, well, Jake, that's too much. I can't afford that. You know, I didn't get a small loan of $1 million, right? I can't afford it. Okay, well then let's try another thing, right? Like let's say, okay, you did 50% SCHD and 50% JEPQ as an example, right? I'm not saying to go do that, but let's say you were able to get a 6.5% yield. Well, that brings your amount invested or that you need to invest down to $154,000. So guys, this is how you look at this. And once again, how are you going to know to do this if you don't know this? That is why on YouTube, half the videos, in my opinion, are not helpful. You know, they tell you the 10 best stocks to buy. That's great. That's fine. It's entertaining. It's great. It's awesome, whatever. But if you truly want to live off your dividend portfolio, this is how you do it. You start with your expenses. You look how far into the future am I going to need to, am I going to retire or no longer work or live off my portfolio? And then you look at, well, I expect my expenses are going to be X, Y, and Z. And then you work backwards. Okay? That is how you do it. That's how you do it. I wish there was content like this on YouTube 10 years ago. Instead of me trying to pick the 10 best stocks of January or February, I wish somebody would have taught me this. This is how you do it. But here's the next thing. Really, really quick. So you got this. Let's use the example, the 10,000, the other piece of it. Let's say you got a portfolio of 4%, right? You got the 250. Okay, so that 4% yield, right? So you got the 10,000, which is yielding 4%. That portfolio of 4% yield is probably going to grow faster than a portfolio that is yielding 6.5%. So that's very, very important that you're factoring that in when you're looking at your portfolio, because if you know that you only need 10 grand and you probably don't need much growth, well then yeah, you can reach for yield. But if you know that you're going to retire in your mid 30s or early 40s, you probably should factor in more growth, because inflation's a thing and you want your portfolio to outpace inflation so that you can maintain your standard of living. So it's really just understanding what situation you're in, but don't forget to factor in, well, in the second year, how much is this portfolio going to grow? Is it going to grow by $600? Is it going to grow by $400? Is it going to grow by $900? And is that going to compound at that rate each year? So everybody, that's how you look at this. Thank you so much for watching. I hope that this video was helpful, and I'll see everybody in next week's video.